All
Okay.
right.
So edit out here, and let's now just go right into the after hours.
Yeah. So how do you like that, Callum? Everything good so far? Any
Yeah,
questions?
yep.
Everything good?
Um, no, that's good. Yeah.
All right.
Okay.
So outside the chart book, what's just before we get back into recording here, is there anything interesting that you want to talk about? Anything that comes to mind that we should set you up for?
Um,
How, if
yeah.
I
You don't
ask
have
you,
to. Don't worry about it. It's
yeah,
okay. We'll
Oh,
listen,
figure
I'm
it
yeah,
out.
just
well,
looking for my list of
if I
We'll
ask
figure
you
it out.
if I ask you about things like your positions on some of the commodities like gold, oil,
Yep.
copper, things like this, you'll have an opinion on all of these types of things, right?
Yeah. Definitely those ones. So I
Okay.
put a list together actually. So I've got commodities, emerging markets, China, um, value stocks, gold, tips, all
Okay.
do you have an opinion about the direction the renminbi or anything like that that you think is worth mentioning?
Um,
We could avoid it if you want. It's up to you.
yeah. It's it's definitely something I'll look at, but I don't have a strong view at the moment.
All right.
Okay.
All right.
Um,
Okay. Let's
yeah.
All right,
okay.
let's do
Let's
it.
go. We'll have some fun.
All
Okay.
right.
Yep.
Okay. Welcome to the After Hours with Callum Thomas. We're going to be chatting about all things New Zealand, and we got to start it off with Callum. My favorite, Flight of the Concords. I don't know. Do you watch that show? Is that what all New Zealanders are like?
Um, I haven't actually watched it that much.
Oh, come
To
on,
tell the
really?
truth.
I love those two guys. I figured all New Zealanders break out into song and do just like those two guys.
Um, yeah, some of us do. We're a bit of an eclectic bunch.
Well, and the other thing is, do you have something? Are you fed up of everybody making Lord of the Ring jokes?
No, it's yeah, bring it on. We're pretty proud of that.
Yeah, well, you should be. I actually would love to come and see Hobbitland or whatever it is, where Bilbo Baggins and Frodo hang out. Have you ever gone?
I haven't actually, but you just go for like a hike or something, up in the mountains or whatever, and you you're basically just seeing all the kind of landscapes and scenes that you saw in the movie. Maybe it's not the exact one, but you know, you still get that sense and that you're in some sort of um, old world or other world kind of thing.
For sure, and you guys are one of the favorites for hedge fund managers. They all seem to be buying property there for the end of the world. Like that's all where their storm shelters are for when. Do you not
Well,
notice
yeah, it's
that they
interesting.
all? Yeah, sorry, go ahead.
Yeah, yeah, it's interesting. Because we've moved in sort of in the last 6 months, but we were in Queenstown previously, which is so if you do come here, that's definitely one of the places you want to go to. And that's where like Peter Thiel has a place there, and Julian Robertson, bunch of other guys too. Probably apparently after 9/11, there was like it was the place in New Zealand, maybe even the South Pacific, where there was the most Bloomberg terminals. So, um, I mean, they could probably actually probably a good business idea would be to set up a little coffee shop there with a terminal in there.
Yeah, that's hilarious. That is funny. I have one of the guys I work with. He's a big doomsdayer guy, and he always tells me that you have to get two gas tanks away from like a major metropolitan, like a major metro area. I'm having trouble with too many beers, but. And because he's kind of thinking that when the end of the world comes, that you want to make sure that the people can't reach you. And I always think it's funny that like how are these guys going to get to New Zealand when the like shit really hits the fan?
Yeah, I don't know. I mean, I honestly, yeah, it probably is a good place to be if things do melt down because you're that far out of the road. But place like Queenstown, at least, you know, the scenery there is amazing. It's a really unique spot actually because that they've got like it's a massive tourist spot and they've got all these world class restaurants, but and like a little kind of city thing. But then the moment you drive like say an hour away, you're in the middle of nowhere. Like
Right.
breathtaking scenery. So it's definitely a good spot to um, get away from it all. And then, the added benefit that, you can jump on your private jet and land there. They've got some private jet parking spots there. So,
Well,
yeah, I guess
I
it's
guess
an
that
added
helps.
benefit.
I kind of
Yeah,
laugh because to me, New Zealanders are to Australians like Canadians are to Americans.
yep,
Like you guys get
yep,
all upset about it when people mistake you, and that's how Canadians feel. Like when we go to Europe, we often get mistaken as Americans, and I
yep,
take it you guys are the same when you go off to Europe or to North America. You get mistaken as
yep,
Australians, and you're like, nope, we're different.
yep, yep. Allow me to allow me to educate you.
Okay, let's talk some markets.
Yep.
Patrick, you have some questions. You wanted to kind of shoot away
Oh,
some
you
things.
know
Go
what?
ahead, bud.
Well, you know what? I didn't like what I heard in the first part, but
Oh, about bonds going down. Yeah, I know. Callum, you have to realize Patrick is very bearish on. Bullish on bonds. So you were talking
look,
more my
there's
language.
a correction coming in
Well, it's
bonds.
a great,
I
it's a
won't.
great spot to,
Yeah.
it's a
Uh,
great trade to have been on.
That's true.
exactly.
You know what? Kudos to Patrick. He finally got one right.
Yeah.
But the going forward, so why don't we talk a little bit about? I actually I'm intrigued by your idea that you were talking about buying emerging markets, which I'm very partial to. But one of the ideas that you also spoke about is kind of off the air was value stocks. What do you feel there? Do you think it's finally time that that the long suffering value managers might see some sunshine?
Um, I yeah, it's something that I've been looking at least on the valuation aspect, and we've reached, if the value of value or the relative value of value, we can sort of get we can sort of get tongue tied there. Um, so I look at the relative value of the price book ratio and forward PEs for value stocks versus growth stocks. And the discount there, I mean, they always trade at a discount because they're value stocks, but the discount between those two is um, like just plain extreme.
Yeah, it's
It's the
off the charts,
same,
right? Like it's
yeah,
crazy.
it's the same for price book ratio as it was at the height of the .com bubble, um, which is quite interesting because it just doesn't feel like .com bubble. But then, forward PE is also at the bottom end of the range. But yeah, it's for value stocks to outperform growth stocks. I think really what needs to happen there is just for growth stocks to get pounded, um, and for value stocks to get just less of a beating. Um,
But is
So
it?
you
that's
so you think it can only get fixed by growth stocks going down and not by value stocks getting bid?
well, yeah, because I mean, I've been looking into the valuation picture there, and it's not as if value stocks are cheap by themselves. It's like they're trading pretty much either in line with historical averages or actually quite a little bit more expensive. But it's the growth stocks that it just stand far far out beyond and above them. So
So
it's kind of like, well, we need like a valuation reversion event to kind of correct that in a way.
how
Yeah,
how
but
much?
the
Okay,
trouble.
no, okay,
Oh, sorry.
Kev, I gotta ask.
Well, I know
Now,
I'm
yeah, I know
dominating
you're
you.
hogging all the questions here.
Yeah. Okay.
So what I wanted to just kind of ask is how much do you feel that the indexing of investors is to do with that? Which is that there. I think I remember a stat from one of the J.P. Morgan guys that like there was just trillions of dollars moving to passive indexing away from the active value managers, which means that this imbalances continue and this kind of mispricing continues largely because just the way money is allocated and it goes in just right into the index and is allocated by market capitalization, and these value stocks simply are not getting their fair amount of allocation. Like, do we have to see a sort of a reversal in the trend of everyone moving to indexing? Am I off base for something like that?
Um, I think indexing definitely would sort of accentuate it, or it would be kind of dragged along because if you think about the growth stocks, they're the ones that are becoming the large caps. So if we just pause for a second and say, what is indexing? Indexing is basically an investment strategy where you buy the largest companies and the companies that are getting bigger and bigger. Growth stocks, I mean, you know, the biggest distinction between growth and value is really about the valuations. That's pretty much the definition. But it's if we actually focused on that term growth, the companies that are growing by definition should be becoming larger and larger, and if they're becoming more expensive as well, then you know index based investors are going to actually definitely going to be pulled into that. Um, I'm just sort of having my eye kind of partly on the screen here. I've got a table that shows the sort of sectoral comparison between the S&P 500 and the growth, one of the biggest growth and value ETFs, and S&P 500, for example, information technology, S&P 500 is 21% to that growth. The growth ETFs 26% to that, and the value ETFs 15% to that. So, you can see that there's definitely a sectoral component to this. So, I mean, if you look at the rest of I guess if you look at the standouts there, the differences, the value ETF has got 21% exposure to financials versus growth. The growth ETF is about 5% to financials. And then the other standouts on the value side are energy, utilities, consumer staples, materials. So there's some kind of like common themes there, but because I guess that would be what's going to actually drive some sort of correction there. The first thing that you think about, well, okay, where's the extreme? The extreme's kind of in valuations, maybe some correction in valuations, broad-based correction in valuations. Growth stocks get hit harder than value stocks. But then the other angle is there some kind of common theme that value stocks are mostly X sector, or they're mostly this kind of company, so that we can be like, okay, well, that sector is quite exposed to this kind of theme, and we can just track these indicators. But aside from financials, I mean, maybe the commodity aspect, maybe financials benefit from higher yields, or a bit more of a yield curve. But yeah, I think trying to figure out something there is there may be something that we could identify, but I just keep on coming back to the simplest answer seems to me to be that in a broad-based correction in valuations, that is basically going to be, let's face it, driven by a market correction or a bear market, is probably going to be an environment where the growth stocks valuations get corrected down more than the value stocks.
I wonder, though, it's Kev here. I wonder if it's going to be accompanied with a rise of inflation, and that's what we need to see before the growth stocks get hammered. Because if you think about growth is the longest duration asset, and it makes sense that investors are rushing into growth stocks because with bonds going bid, and running like they stole something, it makes sense that investors are reaching out for the longest duration part of the curve on stocks, and they're choosing something that that the earnings are far off in the future, because if you think about those earnings, you discount them at a lower and lower rate, so the future value of that, it goes up more and more. And I just wonder if we did get an environment where the world changed and we saw for the first time inflation coming back. And I know Patrick's like he's
I
probably
just
like,
vomited in my mouth a little bit.
Exactly. I was going to say. And if we did see that situation, that would be the change. And when Callum, I understand your argument that value stocks are not exactly cheap. They're just cheap versus everything else. but I kind of wonder what is cheap. There is nothing cheap. Like, go look at, cap rates on real estate. Go look at, private valuations of tech firms. Like, it's just everything is expensive, and the fact that nobody likes this one. Yeah, maybe value stocks are still kind of expensive, or sorry, they're not cheap versus where we've been in the past, but they're cheap versus everything else. And I know the argument that we could solve this by everything else going cheaper. I just wonder if maybe value stocks is this the last thing to rally. Maybe that's the one that we should be waiting for. And at that point, that's the final. At that point, once value stocks rally, that'll be the end of this bull market because there's nothing left else to rally.
Yeah, that's a good question. There's two things that sort of came to my mind while we were talking about that. One that's kind of like a little quirky thing is if you think about growth stocks, like a lot of, just sort of mouthing off here, but a lot of there's been a massive amount of disruption and technological change, and I wonder if we almost need a period of consolidation in that pace of disruption before value can kind of claw its way back. But back to the cycle aspect, I think that you could be onto something there, because if I look at globally what is cheap, emerging markets, commodities, emerging market currencies, those are sort of some of the key things that come to mind on that front, and particularly with commodities, so those are the things that tend to do well later in the cycle as well. And so, yeah, maybe because if you look at those kind of traditional market clock, how a market cycle is supposed to look, it's like bonds rally into the recession, then equities rally into the recovery, and then later on in the thing, commodities rally. So maybe commodities, maybe they're about to have their time in the spotlight.
Right. So, Callum, have you ever seen a time when the bond market guys and gals got so far ahead of the Fed and the economic data? Like, to me, this is just flabbergasting that they priced in 3 cuts before the economy even rolled over. And I don't know what you're thinking on that. Do you think that the bond market is onto something, or do you think that they got way out ahead of their skis?
This is a good question. A couple of things come to mind on that. First of all, is that it's kind of self-correcting in a way, or it's the point I want to mention actually is I was looking at mortgage servicing, because with bond yields coming down this much, that's obviously flowing through to mortgage rates. And since October last year, if you apply the average mortgage rate to the average house price, and you consider that to be basically an indication of how much it's costing to service a home loan, that has come down 25%.
Yeah.
So it's kind of already
They're
the bond
sowing the seeds. The bond market's sowing the seeds of their own recovery.
or their own demise.
Well, yeah, I guess so. Like
they're kind of doing the Fed's job, right?
That's right. Especially with the flattening of the curve and like bringing the long end down. I've just never seen them get so aggressive in assuming that the Fed is so behind the curve and that the economy's gonna fall off so hard. And I thought you had some great charts when you went through your deck earlier, kind of saying, well, the decision you need to make here is to decide, is the Fed really too late, and are we done in terms of, from an economic perspective, in terms of they cut too late and they raised too far, or is this just kind of the pause that refreshes? And that's the question that everyone needs to ask. And I think that you highlighted that properly. But I've just never seen a point where they became so convinced that the Fed was so far behind. And if you had asked kind of up until this unemployment number, if you'd asked everyone yesterday what the chances are that the Fed is has kind of missed it and needs to cut more and get away ahead of it, it was pretty unanimous that the Fed was way behind the curve. And I just thought it was interesting. And to me, it's kind of a new environment. And it's kind of shocking to me how quickly they priced in 3 Fed cuts before the Fed had even cut. And I just don't know.
Yeah.
Like I'd never seen that before. How about you?
Yeah, I'm kind of struggling to come up with some explanations. I mean, I'm thinking of a couple of things come to mind, but nothing that seems really credible. I don't talk to too many guys in that space, but maybe you know one just clutching at straws here. Maybe they've been so kind of like frustrated about the ranging um, markets that we've had over the last few years, and the fact that um, we've had a bunch of near misses where the global economy almost went into a major recession. We've probably had 2 or 3 of those very near misses over the last 10 years, and maybe they're just um, so ready for a downturn that they just wanted to get straight onto it and get
Yeah, I
that
think it's also a
if this
fact
is
that
it, you want to get onto it,
right. I think it's also a fact that they all remember '08, and it's
Oh yeah,
so vivid in their memory. And the Patricks of the world just think the world's going to end every time the economy takes a little bit of a breather, and they just rush out and just start extrapolating the fact that we have a return of '08. And to me, that's what's happening each and every time the economy looks like it might be rolling over.
yeah. So before I started my company, I was working in funds management, and you know, um, just about every time you went to some like kind of governance meeting, that you'd have the question, oh, um, we have to protect against the possibility of another financial crisis hitting the portfolios, and the moment the data would be getting worse, it would be like, oh, is this going to be a repeat of the financial crisis? Um, I, yeah, I kind of had the fortune, in hindsight, the fortune of one of my masters was in banking, and so there's a couple of good things about that. First of all, it's quite good to actually study one industry and
Right.
get a good sort of insight into that. But working in the markets and investing, the banking sector is just so critical, and especially to economic views. And one of the essays that I wrote there was focused on this sort of cycle of financial crisis that we seem to have. Um, we definitely will have another financial crisis at some point. Do we have something on the scale of 2008 happen, you know, this close to having such a major crisis? And you, one of the concepts that we talk about there is this sort of regulatory dialect, and um, perhaps one reason that we won't get something on the same scale as 2008 is because people are still talking and thinking about 2008, and they put all these measures in place, and they kind of have this reaction anytime that we get anything close to it. I mean, we could just have a garden variety little downturn that you know we take our medicine and get back onto back
Well,
to
that
pace.
I'll agree with.
Well, I agree as well. Like the fact is, everyone thinks the next crisis is going to look just like the last crisis, and I argue that the reality is that they never look anything like the last crisis because
Yeah.
everyone's worried about the last crisis. So the
I,
dot com
the U.S.
bubble
banks,
didn't.
the U.S. banks are in better shape
Yeah.
than they've been in a long time. Like the idea that it's going to be like a mortgage crisis or something,
Yeah.
and subprime and all this.
Yeah.
The next crisis will look nothing like the last
I
one. That's for
completely.
sure.
The next crisis is going to be inflation, right, Patrick? Okay,
Oh my
listen. Don't
God.
answer that, Callum. Before you
Yeah,
leave,
actually,
we got.
just on that,
Sorry, go ahead.
um, there, I read one piece actually that was talking about um, how the central bankers, macroeconomic policymakers, their formative years have this sort of lasting impact on policy. Like, if you think about, we've had this sort of era of inflation targeting. Most of the policymakers, most of the people that are the decision makers there, they grew up during the inflation years, the 70s and that, and so, you know, maybe 10 years from now, or maybe already, the the next round of central bankers are going to be, squarely focused on um, preventing depressions and financial crises, and maybe they take their eye off the inflation aspect.
I completely agree. I think it's going to be not even the next decade. I think it's going to be. We're already experiencing it.
I need
But
another beer.
that's a topic for another day. Callum, we can't let you leave without telling us a little bit about Australia. I'm a big bear on the Australian housing market. I think that. They've been the beneficiary of a lot of Chinese capital, and they've taken something and they've taken it a lot too far. And I think it's going to get worse. And even though I think Canada is also benefited from the same sort of money flows, I don't think to the same degree. And I think one of the kind of cleanest ways to trade this is to trade kind of short Australian dollar CAD, which has been one of my favorite positions. But I see that I looked at the other day at the yield curve of the Australian dollar and or the Australian bond market, and there's a lot of already kind of loosening priced into that part of the curve. And I was wondering what you thought about both Australian real estate and also Australian bonds in terms of like the yield curve.
Mm. Yeah. So this was part of something that I was talking about. I think it was last year or the year before. It was this. I coined this term called the scans economies, which is so it's Sweden, Canada, Australia, Norway, and New Zealand, which is kind of a weird grouping of countries, but basically they all had very overvalued housing markets. They all small open economies with their own currency and own central bank, and they're all relatively exposed to commodities and exports. And to sort of understand how we got to this point, they, you know, they kind of they didn't get the same kind of correction in their housing market following the financial crisis because um, commodities kind of carried them through. The commodity aspect kind of buffered their economies a little bit, and then when the commodity crunch came, what did the central banks do? Of course, they did the only thing that they can do, and that's cut interest rates. And how do interest rates affect the economy? I mean, there's a number of ways, but housing's pretty much your key channel in a developed economy. And so you took these housing markets that were already overvalued going into the financial crisis. They didn't correct like America did, and then they just went on a new rally and went to all new expensive highs. So, yeah, the situation now in the Australian housing market, there has been a decent correction. Like they're down, house prices, like average house price in capital cities is down about 10%, I think it is year on year. But already you've got the Reserve Bank's cut interest rates twice now, so they cut again this week, and the banks have actually passed a lot of that through. The other thing, actually, quickly worth noting is part of the reason that we got the correction there in the housing market is that they had this sort of inquiry into the banking sector, and the one of the key results out of that was because I mean, the banking sector is always one that's good to beat up because it's well they if they're left to their own devices, then they're going to make money however they can, and sometimes they get a little bit out of control. And this is kind of what the case was here. And so out of that, they basically you saw a tightening of credit conditions. So um, basically, one of the sort of results of it was that the banks had been, too aggressive in their lending, and so going in the other direction, they kind of, said, well, we're not going to do that anymore. And so somebody, for example, who used to be able to buy an $800,000 house and, get a $700,000 mortgage, now could only get a $600,000 mortgage. So,
Right.
I mean, that's always going to have a massive impact on the housing market because credit's the key fuel there.
Right, but they
And
started. Did they start a? Did they start a chain event, like a chain of events that they can't now stop?
well, a credit tightening like that is a one-off event. Um, it definitely had the risk of setting something off, but whenever I think of the housing market, what is going to really what really kills the housing market? It's either a spike in unemployment or a spike in financing costs, and
Right.
we haven't actually seen either of those.
Yeah.
Maybe we're still yet to see a slowdown in the economy that pushes the unemployment rate up, but you know in and if anything, financing costs are coming down.
Yeah.
Um, the banks have actually passed through most of their latest cut through to mortgage rates. So um,
Yeah.
I was joking with a colleague, fund management colleague in Australia, and that just buy the dip because the economy hasn't rolled over, and now the Reserve Bank's cutting interest rates, and I think APRA even slightly eased the macroprudential rules. So
Right.
yeah, and it's one of those interesting developed economies where you just have quite a flow of immigration. So they've got like I think we used to use like about a 2% population growth estimate there. So it's kind of like a emerging market like developed economy, if you
Right.
know what I mean there. So
Yeah.
um, yeah, I
So you're not quite
don't want
bearish.
don't want to throw caution to the wind there, but it's it's still overvalued. But you know if and you almost need an external shock to push that um, you know to move the dial on the unemployment factor.
Right. I buy that argument that the fact is that if you get a situation where the unemployment, doesn't spike and we continue, the economy keeps rolling along, and the fact that interest rates don't rise and in fact, you know, go down, which is what we're seeing, then that, even though the credit will be causing a revaluation of the housing and might cause people to pull in their reins a little bit, eventually that'll get repriced and then we'll chug higher because you're
Yeah,
absolutely correct that is what drives real estate, those two factors, and I couldn't agree with you more. Anyways,
well,
Callum,
that
it's
credit
been a
tightening's one off. So
right.
that
Yeah,
they've taken the medicine on that now.
for sure. I completely understand. So maybe you're right. Maybe I'm staying in my trade a little too long. Anyways, Callum, it's been a pleasure having you. Why don't you tell us where we can, find more about your work and where people can contact you, and give us a little bit of all that good stuff.
Yep. So probably best place to start is to follow me on Twitter. So Callum_Thomas, or just go onto the website topdowncharts.com. Um, yeah, I've got an institutional research service, and then I've also got a sort of an entry level product there, the top 5 charts of the week. Yeah, come and check it out. Get in touch. Always happy to chat.
Well, thank you very
Well,
much. Thanks for getting up early on a Saturday morning and being on the show. We really
yeah.
appreciate it, Callum. It's
Callum,
been
it
a
was
pleasure
great.
having you
Yeah,
on.
great to talk.
Thank you very much, Callum.